The HSA, we've talked about it before, but this week on Phil's Tax Hacks and Other Retirement Facts, let's talk about, can you really build a tax-free retirement fund using the HSA secret? Let's get into it.
Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show.
Hey everybody, welcome into the podcast. Thanks for hanging out with Phil and I as we talk investing, finance, and retirement. What's going on, my friend? How are you? You doing all right?
Doing good. Knee deep in taxes, but
yeah, I was gonna say this time of the year. Yeah, you're messing with that. We and I both got the plague, I think, over the last little bit. So
yeah,
hopefully,
it seems to be going around.
Anybody who's got it, hang in there because it hangs around for a little while.
It does.
Let's talk about the HSA this week. You know, can you really kind of stockpile this massive balance and use it in retirement? I think we might have shared this story before, Phil, or maybe I can't remember. We've done so many shows, but I saw something years ago where a guy bought a sailboat with his HSA money. And it was like, what? It's like, I thought you had to use it for medical expenses. Well, yeah. he had the receipts to show that he was reimbursing himself, right? Which is what you can do with it. And then I guess after that, you can do whatever you want with the money. So, but let's talk about it. We got a question that came in, okay, from listener Beth. And so she maxes out her HSA and hasn't touched it. So here's her question. She says, I max out my HSA every year, but never actually pull the money out for medical expenses. Okay. I just keep doing this year after year. Am I understanding correctly that I can just build up this big balance and use it in retirement? So let's break it down. Is that factual?
It is 100% factual. And actually would be the advice I would recommend. Okay. I tell clients, I mean, first of all, to have an HSA, you have to have a high deductible plan, right? So it's not just anyone can go open up an HSA account. They're great tools, awesome vehicle to use. However, you have to have a high deductible plan. So, I mean, that's kind of the first hurdle to get over. And, for that reason, it doesn't necessarily work for everyone, right? Because, I mean, if you have some medical conditions where you're going to use it a lot, then maybe the high deductible plan has too much exposure, you're paying too much out of pocket. So it just mathematically isn't going to make sense.
Okay.
So I mean, that's kind of the first thing really to understand. It's not like an IRA or a Roth where anyone can do it. Mm-hmm. To get an HSA, you got to have that high deductible plan, and it has to have made sense. So,
but are there limits or risks to keeping that larger balance? I mean, like obviously somebody doing this is there something we should be? You said you would recommend that, but are there some things to at least be aware of?
No, so I mean there are limits on how much you can contribute each year. So whether you're single is $4,300 for this year, married's $8,550.
Right. So it's not a lot of money, but it's the cumulative thing over time, right?
And that's the key. Right. And then if you're over age 55, you can do another 1,000 per person. So for a married couple, technically you could do $10,550. Okay. The little twist with that though is that, so for a married couple, you can put the $8,550 and the 1,000 extra for over age 55 in one spouse's HSA if they're over age 55. Mm-hmm. If the other spouse is over age 55, though, their 1,000 has to go into an HSA for them.
Okay.
So you do have to segregate it from that standpoint. But in the reason I would recommend it is that it is, I look at HSAs as kind of like a super Roth, effectively.
Yeah. Because you hear them called that all the time, a Roth on steroids or whatever.
And the reason for it is this. I mean, it's better than a Roth in that you get a deduction when the money goes in. So that's the real key with an HSA is all the money that goes in where you take a tax deduction for that, similar to how it would work if you were doing an IRA. But the difference with an HSA, as long as that money comes out for medical purposes, so qualified medical expenses, something you could take as a deduction on Schedule A. Mm-hmm. And there's one exception, we'll talk about that in a second, but, then the money comes out tax-free. So you've got a deduction on the way in, out tax-free. So,
and the growth is tax-free.
And the growth is tax-free as well, right? So to me, it's just another way to add a kind of a medical Roth, so to speak, for retirement. Because, I mean, chances are as you age, you are going to have more medical expenses. I mean, it just makes sense to maybe designate some of these funds for that purpose, and then the money can come out tax-free.
Yeah.
So that's why I recommend somebody that can't afford to contribute And, just the normal out of pockets. I mean, if it's not too absorbent and you can pay for that out of your budget anyways, currently, then let the HSA ride.
Okay.
So because you want it to accumulate over time, and there's really no risk in that because you can always get the money back out in a couple of different ways. So you talked about the story up front about the boat.
Yeah.
So in what I tell clients, how that works, what I tell clients to do is when you have an HSA, in all the years that you've had an HSA and even beyond that, as soon as you've had it, start saving your medical receipts, so create.
Yeah, that's a big key, right? Like you've got to have these, right? Otherwise, and a lot of people are not good at keeping some stuff. So you do need to be a little organized here.
Yeah. So, whether it's an envelope that you're throwing these receipts in, or you've got them on the computer or electronically, you get them by email, whatever it is, save your medical receipts. Because the real key with HSA is there's no time limit on when you take your reimbursements. Okay. So you had, let's say you've contributed, make it simple, $10,000 a year for 10 years. You put in $100,000.
Right.
And let's say you've had $3,000 in medical expenses out of pocket each year in those 3 years. So you've got $30,000 of medical receipts that you can substantiate that these were out of pocket expenses. At any point in time, you can go get that $30,000 out tax-free. And it's not like you've got to submit all these to the IRS. All you're doing is you'll take a distribution. You're going to get a 1099 SA, so distribution from an HSA account, or HSA, I should say. And then when you do that, you're going to have to report it on the tax return because the IRS is going to say, oh, you got $10,000. That's taxable. All you have to do is tell them it's all spent on medical expenses. And then it's really, that's the math behind it. Now you wait, if they want to come and audit and say, well, okay, prove it. Well, that's where the receipts come in play. Right. Now you have to have the documentation like any deduction. Gotcha. If they tap you on the shoulder and say, we want proof. Yeah. But that's the key is having those receipts and that documentation to be able to at some point pull the money out. So
yeah, I mean, clearly it's a very powerful tool, right? So again,
absolutely.
but they require some legwork, right?
Yes,
it's a little back and forth. Now you can also invest the dollars, right? So
absolutely.
should you invest the HSA dollars or leave them in that in that cash stance for a use, right? On you go pay for your chiropractor or whatever.
Right. Yeah. So you can invest the money depending on the HSA custodians. Every custodian's a little different.
Yeah.
I mean, if it's a bank HSA, then probably not, but if you have there's a lot of outside HSA companies now that will work with another custodian, like a Charles Schwab or whatever, or Fidelity, whoever, where then a portion of the money can be invested. And, they'll have their limits if you got to have X amount in cash or whatever, however it works. Whether it should be invested or not, really, to me, comes back to your overall plan and when you're going to need it. For us, how I would look at it is that bucket type strategy. So I mean, if you're now in retirement, let's say, and you're going to use the HSA to start paying for some medical expenses, and it's going to be X amount a year, well, you'll probably want to have a portion of that money set aside in a more conservative investment, or maybe some of it even in cash. Because you're going to need it in a shorter period of time, 1, 3, 5 years. But the money you're not going to need right away, well, yeah, let that grow, so you can invest that based on your risk tolerance.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
So I got to ask the basic question because I'm sure somebody's probably thinking it. So I just mentioned okay, so you got your balance growing on your HSA.
Yep.
You go into, I just use the chiropractor, so we'll just use that. You go into the chiropractor and you're $70 or whatever, right? So you give them the HSA card to pay for that. Now you can't keep that receipt and then claim that again later, right? Because you use the HSA to pay for it.
Right.
This is only if you've paid for that $70 out of, your personal funds.
Correct. Yeah. So there's two ways to take money from the HSA or pay medical expenses from it. You can use the HSA debit card. Most HSA accounts will have a debit card.
Right.
So if you wanted to, at some point in the future, just start paying for your out-of-pocket medical expenses that way, well, then the HSA debit card, and then it's easy because now you've got the HSA statement. It's got the details behind it.
Yeah.
But you don't have to do that necessarily. You can physically write yourself a check from the HSA, deposit it in your bank account. All you have to do, the HSA doesn't care, right? Because the custodian doesn't care. They're going to report whether it's a payment made directly to a medical facility or a check you wrote to yourself. They're going to report it as taxable to you.
Okay.
Then it's up to you to report it on the return and say, well, yeah, I got X amount, but this amount was used for medical. So
gotcha. Okay.
Yep.
All right. So, I mean, I think we covered my last question was really how can retirees, use it strategically? I think we've covered a few pieces. Anything else we didn't cover you want to talk about?
Yeah. So the one kind of caveat you have to understand is what qualified medical expenses.
Okay.
So basically any out-of-pocket expenses, the one that kind of catches some people by surprise is that you cannot pay for any non-COBRA type of medical premiums out of an HSA, including like a Medicare supplement or a Medicare Advantage plan. So as you get in retirement, those expenses, those premiums can't be paid for. You can pay for, however, Part A, although most people don't pay for Part A, Medicare Part A.
Right.
But your Part B premiums, you can. So I mean, you can't obviously pay Social Security from the HSA, but you can take a reimbursement for that.
Yeah.
Beyond that, it's, pretty much anything that is a qualified medical expenses. One that a lot of people overlook is long-term care premiums.
Oh, okay.
So as you age, there's a certain amount of your premium that is considered to be a qualified medical expense. So for instance, somebody in their 50s to 60s, up to $1,690 of whatever your long-term care premiums are considered to be qualified medical expenses. 60 to 70, it's $4,510, and in 70 or more, it's $5,600. So don't forget that again when you're kind of building that list or that bucket of receipts, so to speak, or envelope of the receipts of medical expenses. So,
okay. All right. So, I mean, at the end of the day, it's a pretty useful tool, right?
Yeah. And then a couple other things quickly to consider.
Sure, yeah.
Number one is, so we talked about how to get the money tax-free, which is, I mean, that's the ultimate benefit of it, right?
Right.
But if let's say you build up this massive HSA, you've got $200,000 in the HSA, you're in retirement now and you've got some receipts, but obviously not that amount. Maybe you're thinking, I really don't need that amount in there. How do you get it out? What's the cost or penalty? Mm-hmm. As long as you're over 65, you can take that money out and it's taxed if it's not used for medical, but it's not penalized. If you take the money out prior to age 65, though, you're going to pay the tax, ordinary income tax, and a 20% penalty. Mm-hmm. So just be careful about that. But, as you get into retirement, you can treat it, think of it almost like an IRA, right? It's a taxable account at that point as you pull the money out if you've built up too much in there. The other thing to consider, too, is that from a beneficiary standpoint, if you name a spouse as beneficiary, they can roll that into their own HSA. So they can treat it as their own. So it's a great, great vehicle to use for that. Make sure if you're married, you name your spouse as primary.
Right.
For a non-spousal beneficiary, though, it is not a really good tax benefit because ultimately how it works for them is it's 100% taxable in the year that they inherit it.
Gotcha.
It has to basically come out and go into a bank account or a brokerage account, whatever. But
if it's a big balance, that can sting.
It's 100% taxable in that year. Minus they can pay for any final medical expenses of the owner of the HSA that are paid within 12 months.
Gotcha.
So again, just looking way down the road, something to consider in who you're naming beneficiaries and, as you kind of do the estate planning side of the overall retirement. So,
okay. All right. Well, if you've got some questions or concerns about the intricacies of the HSA, really powerful tool, something if you have it available to you that may be worthwhile to be looking at, but make sure you're talking with your financial professional on how to use it effectively and efficiently and all that good stuff. And of course, if you need some help, reach out to Phil. He'll be happy to help you out with that. You can find the links in the show descriptions below. Go to philstaxhacks.com. But again, we got all the links right there to check out the websites and get in contact with Phil in the show description. Don't forget to subscribe to us on Apple or Spotify in audio form or YouTube on video form as well. Hit that little thumbs up and notification bell so you catch new episodes when they come out. Supports the channel, helps us out, and also gets to hopefully use some useful nuggets of information. So thanks for breaking it down with us, Phil. As always, I appreciate you, my friend. Have a great week. We'll see you next time here on Phil's Tax Hacks and other retirement facts.
Phil?
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.